Hey everyone, Ippolito here. I keep getting the question, what about Canopy Growth earnings? Well, I'm going to show you exactly how you can see what the market makers are expecting for this Canopy Growth, #1 largest cannabis company in the world, earnings reports. Here's how. Pull up your platform and go to the trade tab, or under Thinkorswim it's called Trade All Products, and pull up the option chain. Now, since Canopy Growth reports earnings this week, I'm going to go to the August options. That is the front month options. Since I'm looking at earnings, I'm looking at the weekly options. In this case, since it's August monthly expiration, they expire here in 4 days. How do I know in 4 days? Well, there it says 4. August 16th is the expiration. That's this Friday. Now, with the stock trading here in Canopy Growth at $32.68, I can simply go to the right and see MMM. MMM. That means market makers move. And then right next to it, it says right here, 296. So for purpose of this video, I'm going to round up, you know what, to $3, okay? Listen, I spent enough years doing math and stats. I'm going to give myself a 3-cent roundup from 297 and go to $3. So with the stock at 32.68, if I have a bullish upside view on the case, or what the market makers are thinking, they're saying here that Canopy Growth on earnings, I'm just simply going to add the 32, I'll call it 70, plus $3, and I get 35.70. So that is my upside target. So that is my, I'm going to put an up arrow there. My upside target on Canopy Growth is 35.70. Now what I can do is simple. I can go to the options and see, are they priced correctly? Are they overpriced? Are they underpriced? The 37.5 calls are 32 cents. Meaning, if I'm bullish and I want to buy calls on Canopy Growth, I need the stock to be not only above 37.5, but the price I pay for the calls, so that's about 37.80. And then I make money on the call options. Now, how do I find the downside move? Very simple. Let's see if the puts are priced correctly too. So we have our calls here, 37.5, about 30 cents there. I can go and subtract $3 minus 32.70, or now 32.66. And I get the price of about, it's a little skewed here, but I'm gonna call it here 29.5. Now the 29.5 puts are about 50 cents. So all I'm doing is taking 32. Now we're at, we just dropped a little bit. I'll use 70 and I'll minus $3 there. So I get right there, I get 29.70 or so. So in my opinion, actually, the price of the puts are actually more expensive than the upside calls there. So the calls are only 30, we'll call it 30 cents. The puts are 50 cents. So therefore the market makers in Canopy Growth, they're hedging. Basically they're saying, if you want to buy puts and you think Canopy Growth goes down, they're going to charge you more than they would if you bought upside calls. Now, are the market makers always right? No. But in this instance, they're basically saying, hey, if you, the option buyer, wants to buy puts, we're going to charge you a high amount of premium. Just like, let's say you buy a house in a flooded area or right on the water on the beach, they're going to charge you a premium for those downside puts out there because Canopy Growth over the past few months now has had a downside history with negative news. So they're making those puts expensive out there. If you like it, upside calls are cheap, downside puts are expensive. Use the market makers move of about $3 in Canopy Growth to trade earnings if you want. And one other thing before I go, look at the IV percentage right here. So that's 113%. That is what we call juiced up IV. Just like we said, the puts were expensive. The market makers are not playing. Basically, they're jacking up IV, making those puts expensive. So if you have a longer term time frame or longer term horizon, you could do this. You can actually go to, let's say, September and look at IV drop to 67%. So what you can do if you want to buy options or you want a longer time period, you don't have to play the August monthly options with the juiced up IV. You can actually go and buy longer dated options where the options are actually cheaper, not via price wise, obviously you're buying time, but through an implied volatility time period. Hope it helps. Let me know. Lance Ippolito, Future of Wealth. I'm out of here.